Good evening and welcome to this special half-hour edition of Reality Check. The 2012 election is now behind us. President Obama will remain in the White House for the next 4 years. The House will remain under Republican control for at least the next 2, and the Senate under Democratic control until at least 2014 as well. So what that means for the American people is that little is likely to change when it comes to the issues of the value of our currency and the continued printing of U.S. dollars at an historic rate. The Federal Reserve Bank is something we've devoted quite a bit of attention to over the past year, and tonight we're looking back on some of those stories. Since 2008, the Fed Chairman Ben Bernanke has insisted that he is helping to protect the U.S. economy and keeping the economy afloat. But is that true? Earlier this year, we heard that Bernanke was planning to move forward with another round of so-called quantitative easing. Tonight, we're going to explain what that means, what quantitative easing is, and how it affects you. We begin with a look at part of that report.
Well, analysts are calling it quantitative easing, or QE3. Three, because this would be the third time the Federal Reserve has attempted quantitative easing since 2008. So let's take this one step at a time. What is quantitative easing? Well, the most simple way to explain it, when the economy is slow, one theory, called Keynesian theory, is that the government must stimulate the economy. One way to do that is to lower the interest rate for money that banks lend each other. So, for instance, you've got Bank A, only has a few dollars in reserve. The Federal Reserve prints money, then floods it into Bank A. Well, now Bank A has lots in reserve. In theory, they will then lend lots of extra money to Bank B at a low interest rate. That's the idea behind quantitative easing. Lots of cash, which means everyone starts borrowing and spending and the economy gets going again. The only problem? It isn't working. Keynes' theory isn't working.
So I propose that the federal government reduce the risk posed by these troubled assets and supply urgently needed money so banks and other financial institutions can avoid collapse.
That was the first round of quantitative easing when it came in late 2008 under President George W. Bush. In order to resolve the housing crisis, the Fed initiated purchases of $500 billion in mortgage-backed securities. Remember all those toxic mortgages that had mucked up the system? In late 2008, the Fed cut the key interest rate to near zero. Then, in March of 2009, the Fed expanded the mortgage buying program and said it would purchase some $750 billion more in mortgage-backed securities, QE1, which Fed Chairman Ben Bernanke called credit easing. It was less about buying up bad assets and instead about increasing credit so that instead of worrying about all those bad mortgages, the housing market could just keep on going. Clearly, it didn't work, which led to a decision in 2010 for QE2. QE2 was different from the credit easing of 2008 and 2009. From November of 2010 to June of 2011, the Federal Reserve went to work buying up some $600 billion in U.S. Treasury bonds to spur the economy, printing some $75 billion a month. But again, it didn't help the economy. But since QE2 funds didn't fuel economic growth in the U.S., what did it do? Well, it put additional cash reserves into European banks. During the QE2 funding period, cash reserves of foreign banks grew from $308 billion to $940 billion, the same amount as the increase in the Fed Reserve's balance. So, is the third time the charm? Credit easing didn't work. Pouring money into foreign banks didn't work. What we really need is round three? Well, some analysts are saying yes.
Now, we ended that story a little early because, as we suspected, despite repeatedly saying that there would be no third round of quantitative easing, there was. Just weeks ago, the Fed chairman announced that QE3 would take place. Now, coming up, we're going to explain what QE3 is all about, but let's take a step back here. Where did the Federal Reserve come from? Who oversees it? Earlier this year, the House voted to move forward with historic legislation that would mean the first ever audit, full audit of the Federal Reserve. Here's a look back at that reality check. As Congress passed historic legislation, H.R. 459, also known as Audit the Fed, a coworker asked me this question: how would any of this affect my life? And it's a good question. To understand how the Federal Reserve affects you, first you have to understand what the Federal Reserve is. The Federal Reserve Bank was started in 1913 by an act of Congress, but not really. You see, Congress allowed the creation of the Fed,
But the Federal Reserve Act of 1913 wasn't drafted by Congress. It was drafted under great secrecy in a meeting of associates of very powerful men at a place called Jekyll Island. I know, sounds like a movie, right? The men represented at that meeting, J.P. Morgan, William Rockefeller, and the Rothschild banking family. The wealth of the 5 families represented at that meeting represented at the time 1/4 of all the wealth in the world. If you have not read the book, The Creature from Jekyll Island, you should. It explains in great detail how the Federal Reserve Bank came into existence, and it's a very strange story. Now, I could spend an hour explaining all the details on the history of the Fed, but time won't allow it. So in short, it's critical to understand the objectives of the Federal Reserve. The Fed was drafted with 5 objectives. Number 1, to stop competition from newer banks, especially banks in the western part of the United States. 2, to obtain a franchise to create money out of nothing for the purpose of lending. 3, to get control of all the reserves of other banks so that reckless banks wouldn't be overrun. 4, to shift the losses from the banks to the taxpayers. And 5, to convince Congress that the purpose was to protect the public. So here's how it works. If the government needs money, the U.S. Treasury prints it, but the Treasury needs to get it out to the public. And that's where the Fed comes in. The Federal Reserve Bank will take that newly printed money, which was created out of nothing, then gives it to other banks. The banks then loan the money to you and me, and we pay interest. And the interest we pay then goes back to the Treasury and to the banks who loan the money in the first place. So what's the problem here? Well, the Federal Reserve Bank is not responsible to anyone, not to Congress, not to the President, and most importantly, not to the American people. In 2011, the Government Accountability Office conducted a first-of-its-kind audit of some of the lending practices of the Fed after the 2008 financial crisis. According to Democrat Congressman Bernie Sanders of Vermont, as a result of this audit, we now know that the Federal Reserve provided more than $16 trillion in total financial assistance to some of the largest financial institutions and corporations in the United States and throughout the world. Among the investigation's key findings is that the Fed unilaterally provided trillions of dollars in financial assistance to foreign banks and corporations from South Korea to Scotland. Again, according to that GAO report. Now, the investigation also found that there is no process in which the Fed prevents conflicts of interest. For instance, the CEO of J.P. Morgan Chase served on the New York Fed's board of directors at the same time that his bank received more than $390 billion in financial assistance from the Fed. Moreover, J.P. Morgan Chase served as one of the clearing banks for the Fed's emergency lending programs. And there's more. Take September 19, 2008, William Dudley, who was now the New York Fed president, he was granted a waiver to let him keep investments in AIG and General Electric at the same time that AIG and GE were given bailout funds. Now, one reason the Fed did not make Dudley sell his holdings, according to the audit, was that it might have created the appearance of a conflict of interest. So what you need to know is that this Audit the Fed bill is one of the few bipartisan efforts to pass the House of Representatives in years. 89 Democrats signed on with Republicans to support the bill. But as we've told you, Senate Majority Leader Harry Reid claims that he will not allow the bill to get an up or down vote in the Senate, despite the fact that he himself spent 25 years calling for an audit of the Fed. The biggest question, why? Does auditing the Federal Reserve mean that the Fed will change any of its behaviors? Well, if not, then why not audit them? If so, then all the more reason to shine light on what the Federal Reserve is really doing. And that is Reality Check.
Well, of course, the Audit the Fed bill didn't get very far, and the reason for that was simple. It was never put up for a vote in the Senate, and that in itself is a strange thing, considering who the Senate Majority Leader is. That part of the story when we come back. Welcome back to this Reality Check half-hour special. Before the break, we looked at the history of the Federal Reserve. We also told you about the attempt to audit the Fed, which was passed in the House this year. But that audit didn't get very far, thanks to the most powerful man in the Senate, Senator Harry Reid. But the fact that Reid decided to block the legislation is especially strange when you consider the fact that he spent 25 years calling for that very audit. Here's that Reality Check.
H.R. 459, a bill to audit the Fed, has been attempted in just about every session of Congress over the past decade. Yesterday, though, it was overwhelmingly approved by a vote of 327 for, 98 against. Audit the Fed would allow the U.S. Congress to audit the lending activities and the printing of money conducted by the Federal Reserve. Do you know how much money the Fed is printing? Why during the 2008 financial crisis did the Federal Reserve refuse to give money to investment bank Lehman Brothers before their collapse, but then after they collapsed made a $138 billion loan? Why? Why does the Fed print American money and then lend it to foreign banks? During the height of the 2008 crisis, 70% of bailout money went to banks overseas. Why is that? How much of our own debt is the Fed buying up? There are a lot of questions that surround the Federal Reserve, but many Americans may not realize this. But right now, no one, not even the president himself, can look at the Federal Reserve's books. It's a private institution that has the single greatest power over our economy. You see, no one actually knows where the Fed's directives come from. The Fed operates independently of the U.S. government. Its decisions do not have to be approved by the president or any branch of government. But the Fed still sets all interest rates, decides how much money to print, buys our debt, and creates inflation. All of it without any oversight from elected leaders. Thus, Audit the Fed, a bill that says the Fed must have some level of transparency and accountability for the decisions it's making. So now that Audit the Fed has passed the House, the bill will move on to the Senate, which should mean it has a good chance of passing. Why? Because Congressman Ron Paul isn't the only longtime lawmaker who has advocated auditing the Fed. This is video of Senate Majority Leader Harry Reid on January 23, 1995. Listen.
I have sponsored legislation that would call for an audit of the Federal Reserve System. I offer that amendment every year. Every year, the legislation gets nowhere. I think it would be interesting to know about the Federal Reserve. I think we should audit the Federal Reserve. It's taxpayers' money that's being used there, but we don't do that. Even though there is no entity in the world that controls our lives more than the Federal Reserve System.
And that again was Senator Reid in 1995, the same Harry Reid who is now the Senate Majority Leader. Getting a vote on Audit the Fed should be a slam dunk, right? Well, apparently not. The Senate Majority Leader has said that he will not put it up for an up or down vote, making it dead on arrival. Well, can he do that? He can. In the U.S. Senate, legislation is placed on the legislative calendar. Scheduling of that calendar is the job of the Majority Leader. Bills, though, can be brought to the floor whenever a majority of the Senate chooses. So why would Senator Harry Reid, who in 1995, as you just saw, said that every year he pushes for an audit of the Federal Reserve System, now say no? Again, the clip we showed you was in 1995. It was made 17 years ago, so maybe he's changed his mind. Then again, maybe not. This is Senator Reid in 2010 while trying to hold on to a Senate seat in Nevada.
I called for a Federal Reserve audit in 1987, So I agree with my opponent on that. There should be a Federal Reserve audit. We haven't gotten it yet. But we've made some progress in that regard.
So what you need to know is what many Americans should want to know. How does the Majority Leader in the Senate argue, in his words, since 1987, that the Federal Reserve should be audited? And then when a bill that he's been asking for 25 years finally heads into his chamber, he says he won't allow it to get an up or down vote. I called the senator's office today, asking him to explain how that happens. I'm still waiting. And that is Reality Check.
So no audit of the Federal Reserve. And it's not like the Fed isn't incredibly busy, ordering the printing of a record amount of money. When we come back, we'll explain what quantitative easing 3, QE3, means for you. Well, welcome back to the Reality Check half-hour special tonight. We're talking about the Federal Reserve Bank. As we've told you, efforts to audit the Fed for actions it's taken in the past are not moving through the Senate. Well, meanwhile, the Fed continues to move forward with a process called quantitative easing. It's something the Federal Reserve has done twice since 2008. Earlier this year, Fed Chairman Ben Bernanke announced something called QE3. Here's a look back at a reality check that explains what QE3 is all about.
Let's start with what QE3 even means. QE, it's short for quantitative easing. The 3, because since the Wall Street mess of 2008, there have been 2 other attempts at quantitative easing by the Federal Reserve. So let's take this one step at a time. What is quantitative easing? The most simple way to explain it, most Americans know of only one economic theory. It's called Keynesian theory. The idea is that when the economy is slow, the government or central bank must stimulate it. Now, one way to do that is for the Federal Reserve Bank, which is a private bank, not a branch of government, orders the printing of new money and lowers interest rates. That is quantitative easing, leveling out drops in the market. By putting that money into the economy, Keynesian theory says that people will start spending, banks will start lending, people will borrow, and the economy will get back to humming along. That is Keynesian economic theory. So, if we're talking about QE3, doesn't that mean there have been two other forms of quantitative easing since 2008? Well, yes. The first round of quantitative easing came in late 2008 under President George W. Bush. In order to resolve the housing crisis, the Fed initiated purchases of $500 billion in mortgage-backed securities. Because remember, bad mortgages were the problem, right? In late 2008, the Fed cut the key interest rate to near zero, QE1. A year later, Bernanke was added again, though. QE2 was different from QE1. Under QE2, from November of 2010 to June of 2011, the Federal Reserve went to work buying up $600 billion in U.S. Treasury bonds to spur the economy. But again, it didn't work. But since QE2 funds didn't fuel economic growth in the U.S., what did they do? Well, it put additional cash reserves in European banks. During the QE2 funding period, cash reserves of foreign banks grew from $308 billion to $940 billion, the same amount as the increase in the Fed's reserve balance. So, let's be clear. QE1 printed money, gave it to banks to fix the mortgage crisis, but it didn't work. The average person wasn't helped, but banks got billions of dollars. Then QE2 printed money, gave it to foreign banks to spur the economy, and it didn't work. But European banks got billions of dollars. I bet you can guess what QE3 does. To start with, we really shouldn't call it QE3. We should more correctly call it QE infinity. Because while other quantitative easing efforts had ending points, this one does not. Last week, Fed Chairman Ben Bernanke announced the Federal Reserve will purchase $40 billion a month in mortgage-backed securities indefinitely from financial institutions. They will also keep interest rates at 0% until at least 2015. So how will this help you? It won't. Borrowers won't see any help from this, but the profit will go to, guess who? The banks. So what you need to know is that there's no evidence that QE anything will create jobs, encourage lending, borrowing, or spending. The last 4 years have proven that. But there is a hard truth here. The Federal Reserve Bank, through Bernanke and under Keynesian theory, believe that they have to keep printing currency and giving it to banking institutions and keep interest rates near zero in order to hide how massive our debt is. The hard truth? The other economic school of thought, called Austrian economics, says it will all crash. But the longer the Federal Reserve Bank keeps prolonging corrections in the market that have to happen at some point, the more pain there will be. QE3 or QE infinity, whatever you want to call it, just means that day of reckoning, which is coming, will be all that more severe when it gets here. And that is Reality Check.